Imagine, you buy into a community bank stock, right? You're doing it for that rock-solid dividend.
Right, like a high-yield savings account alternative.
Exactly. You treat it like a savings account. And then you check your portfolio one morning, and the new CEO has not only suspended that dividend entirely, just gone, but he's gone on a public earnings call and casually admitted the bank is sitting on $30 million in commercial loans that are completely, unequivocally worthless.
And we're not talking about impaired loans here, not something requiring a slight haircut.
No, I mean zero. We are talking about 0 cents on the dollar in recovery. So welcome to a very special Talk Tickers deep dive. Today we are dissecting the Q2 2026 earnings call of BCB Bancorp. Ticker symbol is BCBP.
This one is it's a real-time autopsy of a corporate turnaround.
Yeah, it really is. And we are unpacking what happens when the bill for that whole zero interest rate era hubris finally, comes due.
It is a brutal but frankly fascinating diagnostic landscape to look at because earnings calls, especially in the regional banking sector, they're typically so heavily sanitized.
Oh, absolutely. Management teams usually employ, this whole army of investor relations professionals just to wrap their bad news in layers of macroeconomic excuses.
Right. They blame the Fed. They blame the weather.
Exactly. But what we have with BCBP is this massive deviation from that norm. We have a new CEO, Thomas O'Brien, and he is exactly 60 days into the job at the time of this call.
60 days.
Yeah, 60 days. And he has totally bypassed the usual corporate doublespeak and opted for a strategy of just extreme, almost aggressive transparency.
Well, that 60-day mark is, it's crucial context here, right? Because in corporate governance, that first quarter under a new chief executive is traditionally the kitchen sink window.
Oh, yeah. Throw everything out.
Right. O'Brien is using this exact moment to turn over every rock, find every single skeleton the previous management team buried, and just toss them out onto the front lawn for Wall Street to look at.
Because he can comfortably blame the previous regime for the carnage today. He's drawing a hard line in the sand. Yeah, and for us, operating under our Talk Tickers mandate, which for those listening means we are data forward, we use plain language for complex stuff, we take an opinionated stance, and we demand actionable insights. This call is an absolute goldmine.
It really is.
We're looking at a masterclass in how a bank cleans up the sludge.
And that word sludge, that's actually a direct quote from O'Brien on this call.
Which is wild for CEO to say.
Right. It tells you everything you need to know about his view of the legacy loan book. And I think my overriding thesis, as we dig into these transcripts, is that BCB Bancorp serves as the ultimate cautionary tale for that 2020 to 2023 banking environment.
Yeah, the easy money era.
Exactly. It shows exactly what happens when a localized institution decides to outrun its own underwriting expertise, like chasing high yields in specialized sectors it fundamentally does not understand.
Which we're going to get into because it is fascinating.
We are. And more importantly, for the retail investor listening to this call maps out precisely how agonizing the structural cleanup process is for the common shareholder.
Okay, so let's lay out our structure for today. We're going to hit this in 4 parts. First, the headline numbers. Second, the story behind those numbers. Third, management's forward guidance. And finally, the bottom line, bull or bear.
Sounds good. Let's start with the numbers.
Right, because when you look at the raw data right off the top, the income statement actually presents this bizarre optical illusion of health.
It does look okay at first glance.
Yeah, I'm looking at their core engine. And operating revenue is holding remarkably steady. I mean, they're consistently generating $25 million per quarter.
Which is solid.
Annualize that, you've got a $100 million revenue machine. For a community bank of this size, that is a highly functional core operation.
And that operational core is what makes this entire situation so complex. I mean, if the core engine were broken, if they couldn't generate loans or attract deposits at all, this would just be a straightforward liquidation story.
Right, they just pack it up.
Exactly. But they are generating substantial top-line revenue. The engine is running. The problem is there are massive leaks in the fuel line.
Which brings up the net interest margin, the IM.
Right, the IM.
It actually expanded by 8 basis points, pushing it over 3%. Now, in the current rate environment, a NIM expanding past 3% looks fantastic on a headline scanner.
Oh, absolutely. Retail investors love to see that.
But, and here's the catch, when you read the transcript, the CFO, Chaudhry, admits this margin expansion wasn't driven by aggressive, high-quality loan growth.
No, not at all.
It was driven by, quote, balance sheet shrinkage. They are purposefully getting smaller to make the margins look wider.
It's a defensive contraction. And investors need to recognize this maneuver immediately.
Walk us through that. How does shrinking make the margin look better?
Well, when a bank shrinks its balance sheet to boost NEM, they are typically targeting the liability side first. During their aggressive growth phase, BCBP likely took on highly expensive wholesale funding, maybe heavy broker deposits or Federal Home Loan Bank advances just to fund their loan demand.
Right. They were borrowing expensive money just to keep growing.
Exactly. And now they're letting those expensive non-core liabilities run off. By shedding the most expensive money they borrowed, their cost of funds drops.
So the denominator shrinks, basically.
Yes. And on the asset side, they're likely letting lower-yielding short-term loans mature without renewing them, or intentionally rejecting new loan applications that don't meet a much higher yield threshold.
So if you trim the expensive fat on the liability side and you drop the low-yield assets on the other side, the spread between what's left naturally widens.
Exactly. The percentage goes up, but it's a larger slice of a rapidly shrinking pie. It is triage, not organic growth.
Triage. That's the perfect word for it. It's a mathematically sound strategy for survival, but, you cannot shrink your way to long-term prosperity.
No, you can't. But it buys them time. And they desperately need that time because the expenses they're taking against that $25 million revenue engine are just staggering.
Let's talk about those expenses, because this is where the parking brake gets pulled on that revenue engine. The bank recorded a $19 million loan loss provision for the second quarter alone.
$19 million in one quarter.
Yeah, and what really stands out in the transcript is that $16.7 million of that provision is specifically firewalled for the commercial and industrial portfolio, the C&I book.
Right.
But here's the kicker, and this blew my mind. This wasn't driven by their internal quantitative models.
No.
The CFO explicitly stated this massive reserve build was driven by a, quote, qualitative framework after they brought in outside consultants to review the book.
Yeah, and that is a profound admission of internal failure right there.
Explain that for the folks at home. What's the difference between the model and the qualitative framework?
Well, under the current expected credit losses standard, or CECL, banks are supposed to use robust, forward-looking quantitative models to predict loan losses. It's all algorithms and historical data.
So a machine tells them how much to hold back.
Exactly. But when a new CEO walks in, brings in outside consultants he's worked with before, and they immediately force a massive qualitative overlay on top of those models.
Right.
It means the new regime has looked at the bank's internal modeling and said, we do not trust a single number this machine is spitting out.
They bypassed the algorithm because the algorithm was fed bad assumptions by the old team.
Precisely. The consultants looked at the macro risk factors in that C&I portfolio and essentially forced management to take the hit today. They are hoarding cash against future failures they haven't even officially realized yet.
It's a $19 million anchor dropped right onto the income statement.
And we know the consultants were right to force that provision because of the actual charge-off data in the quarter.
Right, let's look at the actual realized losses.
Yeah, because a provision is just an accounting reserve, right? It's setting money aside. But a charge-off is the storm actually making landfall. The bank officially recognizes the loan is dead and wipes it off the books entirely.
And the jump here is terrifying. In the first quarter, C&I charge-offs were a manageable $800,000. In the second quarter, they spiked to $5.8 million.
A more than seven-fold increase in actual realized losses in a single 90-day window.
Just brutal.
When charge-offs spike like that, it instantly validates the consultant's panic. The bleeding isn't theoretical anymore. It is actively hitting the capital ratios today.
Which is precisely why O'Brien is rushing to cleanse the balance sheet of anything that isn't a hard, tangible asset.
Oh, absolutely.
And that perfectly explains the other massive hit a quarter, a $5.3 million goodwill write-off.
Yeah, that was interesting to see.
Now, usually I look at goodwill impairment and I kind of shrug. It's a non-cash accounting ghost. It's basically the premium a bank paid over tangible book value during past acquisitions.
Right. They're paying for the brand name, the supposed synergies.
Customer loyalty, whatever. But taking the entire line item down to absolute zero in one quarter, that sends a very specific message to the market.
It is the ultimate psychological clearing of the deck.
Yeah.
By wiping out the entirety of the goodwill, O'Brien is forcing the market to value BCB Bancorp solely on its hard, tangible equity.
He's stripping away all the fluff.
He is implicitly stating that whatever premium the previous management team paid for their past acquisitions, whatever strategic genius they claimed to possess, was entirely illusory.
Wow. Yeah, it's an admission that the bank just overpaid for assets that are now totally underperforming.
Exactly. For a retail investor, seeing goodwill go to zero is harsh, sure, but it is necessary.
Yeah.
You don't want phantom assets propping up the book value of a turnaround play.
No, you want the absolute floor.
Right. You want the floor, and O'Brien just established it by deleting $5.3 million of vaporware.
Okay, so the stage is set for part two, the story behind the numbers. We have a bank generating solid top-line revenue, but deliberately shrinking its balance sheet, taking massive consultant-mandated loss provisions, watching actual charge-offs go parabolic, and erasing its own acquisition history.
It's a lot to take in.
It is. So the immediate question for anyone holding this stock is, how did the underlying assets get this toxic?
How did we get here?
Right. Management points directly to an era of aggressive growth from roughly 2020 to early 2024. And O'Brien's exact words on the call were that the bank entered business lines they, quote, did not fully understand.
That phrase should send a chill down the spine of any bank regulator listening.
I mean, seriously, did not fully understand.
The fundamental premise of community and regional banking is local expertise. They are supposed to understand the idiosyncratic risks of their specific markets better than the monolithic Wall Street banks.
Right, that's their whole value prop.
But we have to contextualize the macro environment from 2020 through 2022.
Okay, let's set that scene.
The Federal Reserve had pushed interest rates to zero. The government was flooding the economy with stimulus and liquidity.
Banks were drowning in deposits. People just had cash sitting everywhere.
Exactly. They were flush with cash, but traditional, safe loans like standard single-family mortgages or high-grade corporate debt were yielding virtually nothing.
Right, you couldn't make any money off the safe stuff.
So the pressure on bank executives to generate yield and maintain their net interest margins was immense.
They had to put that money to work somehow.
And in that environment, the temptation to stray outside your core competency is overwhelming. Banks start convincing themselves that they have the risk management chops to dabble in high-yield, trendy niche markets.
They chase the yield and just ignore the structural risk.
They absolutely do.
Which brings us to the specific portfolios that are currently blowing up BCBP's balance sheet. The first one highlighted on the call is something called the Business Express portfolio.
Ah, yes. Business Express.
The CFO laid out the numbers, and they are grim. In 2024 and 2025, this specific portfolio was bleeding, hitting $10 million in losses annually.
$10 million a year just on this one product line.
Yeah. Now, year to date in 2026, the losses have moderated a bit to about $1.1 million, and they've set a 15% reserve coverage ratio specifically for this book. But looking at the mechanics of a Business Express loan, this looks like a classic case of a traditional bank trying to play the fintech game and getting badly burned.
That is precisely what it is. I mean, when a traditional bank launches a product with Express in the name, it almost universally means they sacrifice deep, fundamental underwriting for speed and volume.
They want that instant approval vibe.
Right. They try to compete with alternative online lenders by offering small businesses frictionless access to unsecured or loosely secured capital.
Meaning what? How does that work in practice?
It means heavy reliance on automated FICO score algorithms, minimal on-site due diligence, and really streamlined documentation. You just fill out a web form and get cash.
It's algorithmic lending, but without the proprietary data models that actual fintechs spend billions of dollars developing.
Exactly. And the trade-off for that speed is catastrophic risk when the economic cycle turns. O'Brien noted that they recently sent teams to actually do site visits and review the payment histories manually for these loans.
So they're finally actually going to look at the businesses they lent money to.
Yeah, and his conclusion was that these Business Express loans are entirely binary.
Now, binary is a terrifying word in commercial lending.
It is.
He means these borrowers either make the payment or they default, and there's absolutely nothing of value for the bank to recover.
Right, there is no hard collateral backing the paper.
So if a local restaurant took a Business Express loan to cover payroll and then goes under, the bank can't repossess the used fryers to make themselves whole.
No, it's just gone. The money is gone.
And that leads directly to the most jarring statistic of the entire earnings call. This is the one that made me pause.
I know exactly which one you're going to say.
Since the fourth quarter of 2024, BCB Bancorp has charged off $30 million in loans at 100% of their value.
$30 million at 100% severity.
When I read that, I had to stop and reread the transcript. Getting back 0 cents on the dollar in commercial lending is an anomaly.
It is extremely rare.
If a commercial real estate loan goes bad, usually the bank forecloses, takes a property, and liquidates it. Even in a terrible market, you recover 50, maybe 60 cents on the dollar. Taking a complete zero on $30 million means the collateral was a total mirage.
It means the underwriting was not just flawed, it was structurally broken from the moment the ink dried.
How does that even happen?
Well, to take a 100% severity loss on a commercial asset, one of three things has to happen. Either the asset was legally unseizable due to a flaw in the loan documentation.
Like they literally messed up the paperwork.
Right. Or second, the asset was entirely fictitious, like straight up fraud.
Okay.
Or third, the asset was so hyper-specialized that its value evaporated the second the original business failed.
And based on the Q&A section of the call, we know BCBP fell victim to that third scenario.
Yeah, they got caught in the hyper-specialization trap.
Yes, the analyst Q&A is where the real story always hides.
Always.
Ross Haberman asked specifically about the bank's cannabis lending portfolio, which sits between $69 and $70 million right now.
That's a huge chunk of change.
And O'Brien confirmed that a massive write-off late last year was tied directly to a single cannabis warehouse facility in Massachusetts. This is the perfect distillation of that zero interest rate era hubris we were talking about.
Oh, it really is.
On paper, it's just a warehouse loan. But O'Brien admitted their fatal mistake. They failed to underwrite it as a, quote, specialty property.
And this is the critical, actionable insight for any investor looking at regional banks today. You have to differentiate between fungible real estate and highly specialized assets.
Break that down for us. What's the difference?
Okay, so a standard logistics warehouse, think of just a concrete box with loading docks, is fungible.
Fungible meaning interchangeable.
Exactly. If your tenant goes bankrupt, you evict them, give the place a fresh coat of paint, and lease it to Amazon, FedEx, or a local plumbing distributor. The collateral retains its baseline market value because lots of people need a concrete box.
Right. But a commercial cannabis cultivation facility is the exact opposite of a concrete box.
It really is. A cannabis grow house is a heavily engineered, deeply specialized industrial environment.
Right. It's basically a laboratory.
Yeah. The operator has to pour millions of dollars into industrial-scale HVAC systems to perfectly control humidity and prevent crop loss from mold. They install specialized high-intensity lighting grids that require massive electrical substation upgrades.
Because they're drawing insane amounts of power.
Exactly. They reinforce the walls. They install bank-level security systems mandated by state regulators. They build complex water filtration and nutrient delivery plumbing.
So the bank's appraiser comes in, looks at all this expensive infrastructure, and values the building at, say, $10 million because it is a turnkey, state-of-the-art cannabis facility.
Right. And the bank lends against that inflated $10 million valuation.
And that is the trap. Because the moment the cannabis operator fails, maybe because wholesale cannabis prices plunged, or they failed to get their permanent license, the bank takes possession of the property.
And here is where it all falls apart. To a standard logistics company looking to lease space for pallets of paper towels, all of that specialized infrastructure isn't just useless, it is a massive liability.
Right, they don't want it.
The new tenant doesn't want industrial grow lights or specialized humidity controls. The bank has to spend a fortune just to rip all of that out and retrofit the building back into a vanilla warehouse.
So the alternative use value of the collateral is completely disconnected from the appraised value as a going concern.
Precisely. O'Brien stated it perfectly on the call. The property had a lot of value for its specific use, but once it had to be repositioned for a different use, the value was pretty much decimated.
So the bank thought they had a hard collateral safety net, but they were actually entirely exposed to the operational risk of a highly volatile, trendy industry.
Exactly. They didn't have the specialized underwriting expertise to calculate the true downside liquidation value.
And the sludge rising to the top, as O'Brien calls it, is just the delayed realization that the collateral never really existed in the first place.
Right. It was an illusion tied to a specific business model.
And the terrifying part for investors is that this isn't just a historical footnote. O'Brien explicitly warned on the call that the absolute level of criticized and classified loans remaining on the books is still, quote, pretty shockingly high.
That phrasing is, I mean, when a turnaround CEO with decades of workout experience uses the phrase shockingly high to describe his own loan book, the market needs to pay immediate attention.
For sure. Translate those terms for us. Criticized and classified.
In regulatory parlance, a criticized loan is one showing early signs of weakness. Maybe the borrower's debt service coverage ratio is slipping.
They're struggling to make the payments, basically.
Right. But a classified loan is actively compromised. That means the bank has formally recognized a distinct possibility of loss if the deficiencies aren't corrected quickly.
So it means that the massive $16.7 million provision they took this quarter is likely just the down payment on a much larger cleanup bill.
Exactly. They are still auditing the rest of the commercial real estate and C&I books. They are not done looking for bad cannabis warehouses.
Which logically forces management into aggressive, real-time triage, leading us to part 3. Management defense and structural maneuvers. They have diagnosed the toxic assets, but now they have to ensure the corporate entity actually survives the surgical removal of those assets.
Right. The patient has to survive the operation.
And the structural maneuvers are, frankly, brutal. The most immediate action was the complete suspension of the common share dividend.
Which is standard.
Yeah. As we noted, cutting a common dividend is a rite of passage in a banking turnaround. Retail investors flee, income funds automatically sell, the stock tanks, but it stops the bleeding.
It keeps cash in the bank.
However, BCBP went a step further. They suspended the dividend on their preferred shares as well.
And that is a massive red flag. Suspending a preferred dividend is an entirely different magnitude of distress.
Why is that? What's the difference to the bank?
Well, preferred shares sit much higher in the capital stack. They are senior to common equity and are marketed to investors almost like bonds, right? They're prized for their fixed, reliable yield.
Right. People buy them for safety.
Exactly. A bank does not suspend a preferred dividend unless they are facing an immediate existential need to hoard cash. It is the corporate equivalent of pulling the emergency brake and locking the vault from the inside.
And the reason they need to hoard that cash introduces a structural banking concept that I guarantee most retail investors checking the stock ticker on their phones completely misunderstand.
Oh, 100%.
The concept is double leverage. O'Brien specifically cited the absolute level of double leverage at the holding company as the major roadblock to resolving their capital structure.
This is where we really need to dissect the architecture of the modern banking system for the listener.
Let's do it.
When a retail investor buys shares of BCBP on the open market, they are not actually buying the bank.
Wait, what?
Right. They are buying equity in BCB Bancorp Incorporated, which is a bank holding company.
Okay, a holding company.
The holding company is, for all intents and purposes, just a legal shell. That shell owns 100% of the actual subsidiary operating entity, which is BCB Community Bank.
So the holding company is the parent,
yeah,
and the operating bank is the child.
Correct. Now let's go back to that aggressive growth phase from 2020 to 2023. As the subsidiary bank, the child rapidly expands its loan portfolio by funding cannabis warehouses and business express loans, banking regulators step in.
The regulators demand they hold more capital against those risky loans.
Exactly. Regulators require them to hold a proportional amount of capital against those assets to protect depositors. Growth consumes capital. So the subsidiary bank tells the parent holding company, we need more equity to satisfy the regulators.
But the parent holding company doesn't want to issue new common stock.
Right, because that would dilute the existing shareholders and depress the stock price.
So what do?
So the holding company does something incredibly clever and incredibly dangerous. The holding company goes into the institutional debt markets and borrows money. In the case of BCB Bancorp, they issued roughly $40 million in subordinated debt.
Okay.
The parent takes that borrowed cash and pushes it down into the subsidiary bank, logging it as equity capital.
That is wild. The debt of the parent magically transforms into the equity of the child. That is double leverage.
That's double leverage. It is a precarious high-wire act. The parent holding company now has an ironclad legal obligation to pay interest on that $40 million of subordinated debt every single quarter.
Right.
But remember, the holding company is just a shell. It doesn't make loans. It doesn't collect interest. It has no independent cash flow.
So how does it pay the interest?
Its sole source of liquidity to service its own debt is to receive cash dividends upward from the subsidiary bank.
Oh, wow. It's the ultimate financial dependency. If I can use an analogy here, It's like a father taking out a massive second mortgage on his own house just to fund his son's risky tech startup.
I love that analogy.
The father now has a huge monthly mortgage payment. But the only way the father avoids foreclosure is if the son's startup generates enough profit to pay the father a monthly dividend.
That analogy is spot on, and it explains exactly what happens when the son's startup, the subsidiary bank, starts choking on $30 million in bad cannabis and C&I loans.
The son's profits evaporate.
Yes, the subsidiary bank's profits evaporate. They can no longer afford to send cash up to the parent.
And this is where the regulators step in and make it infinitely worse for the parent, right?
Oh, they do. If the subsidiary bank is distressed, the regulators will explicitly forbid the bank from sending any dividends upstream.
Because they want to protect the depositor.
Exactly. The regulators trap every dollar of liquidity at the bank level to protect the FDIC insurance fund and the local depositors.
Leaving the parent holding company completely starved of cash, yet still legally obligated to make the interest payments on that $40 million of subordinated debt.
Right. The holding company faces an immediate liquidity crisis, completely separate from the bank's operational issues. That is why O'Brien had to ruthlessly suspend the common and preferred dividends.
He's just trying to find pennies in the couch cushions at the holding company.
He is trapping whatever trickle of cash is left at the holding company level just to keep the subordinated debt holders at bay.
This precise tension was highlighted in, honestly, the most chilling moment of the earnings call Q&A.
Yes, the Haberman question.
Analyst Ross Haberman asked a logistical question. He essentially asked O'Brien, if push comes to shove, can you just defer the interest payments on that $40 million of sub-debt to give yourselves some breathing room?
And O'Brien's response was instant. He just said, if we deferred it, it would be an event of default.
Instant death. If they miss one interest payment, the institutional lenders holding that subordinated debt can accelerate the loan, demand immediate repayment, and force the holding company into bankruptcy.
Even if the subsidiary bank itself is still operating and taking deposits.
That is the terror of double leverage during a credit contraction. It weaponizes a loan problem at the subsidiary level and turns it into a fatal liquidity event at the holding company level.
It really does. And understanding this dynamic perfectly frames the other legal maneuvers management announced on the call.
Right, because they are moving to change their state of incorporation to Delaware, and they are eliminating their staggered board of directors.
Now, when I see a distressed company suddenly rushing to reincorporate in Delaware, I don't assume they just like the weather in Wilmington, you know?
Yeah, exactly. What is the strategic imperative here?
It is all about legal predictability and setting the table for corporate restructuring. Delaware Chancery Court is the undisputed gold standard for complex financial workouts, mergers, acquisitions, and recapitalizations.
The judges there know exactly what they're doing.
The legal precedents are established and fast. Furthermore, eliminating a staggered board where only a fraction of directors are up for election each year makes the entire board accountable simultaneously.
It removes the poison pill.
Exactly. Because if a private equity firm or a larger acquiring bank is going to ride to the rescue and inject the capital needed to save the holding company, they demand immediate control.
They aren't going to wait around.
No, they will not inject $50 million if they have to wait 3 years to replace the legacy board members. O'Brien is systematically dismantling the defensive architecture of the bank to make it legally palatable for an external savior.
And as they execute this legal maneuvering, they also announce they are exiting the consumer lending business entirely to focus solely on commercial banking.
Right.
They noted the legacy consumer portfolio is performing fine and will just run off naturally, but it signals a massive contraction in their strategic scope. In the meantime, O'Brien warned that operational expenses OPEX will remain highly elevated for the foreseeable future.
Because you cannot execute a turnaround of this magnitude cheaply.
Lawyers aren't cheap.
No, they are paying specialized loan workout consultants to dig through the Business Express files. They are paying elite Delaware restructuring attorneys. They are likely paying investment bankers to model capital raise scenarios.
And all of these professional fees are going to act as a massive drag on that $25 million quarterly revenue engine we talked about earlier.
Yeah, that engine is burning fuel just to stay in place.
However, buried in the balance sheet discussion was one fascinating lifeline. They have a $25 million deferred tax asset, or DTA, Haberman pressed them on this as well.
Yeah, the DTA.
When I see a DTA of that size on a distressed bank, my mind immediately jumps to the tax code, specifically Section 382. But before we get there, let's establish what this actually is. It's essentially a massive tax coupon generated by their current misery.
Correct. In bank accounting, when management takes a massive provision for loan losses, like the $19 million they just took, it crushes their GAAP accounting profit.
Right.
But the IRS doesn't actually care about consultant-driven qualitative provisions. The IRS will not let the bank deduct those losses on their actual tax return until the loans are officially declared dead and charged off.
So there's a delay.
Exactly. Because of this timing mismatch between accounting rules and tax rules, the bank generates a deferred tax asset. It represents future tax savings.
It's an asset on the balance sheet, but it's completely illiquid. You can't use it to pay your employees or service your subordinated debt.
Right. Its value is entirely theoretical right now. The only way a DTA has tangible value is if the bank survives the turnaround and returns to generating robust taxable net income.
So if BCB Bancorp successfully purges the sludge, shrinks back to a healthy core, and starts earning real profits again, they won't have to pay federal income taxes for years.
Exactly. They can just apply that $25 million DTA shield against their future tax bills.
But the flip side is brutal. If the bank continues to spiral, and the holding company defaults on that double leverage, there are no future profits to shield.
And that triggers a valuation allowance. Accounting standards dictate that if it becomes more likely than not that the bank will not generate enough future income to utilize the DTA, they have to write it down to zero.
Just like the goodwill.
Just like the goodwill. If they have to write off a $25 million DTA, it takes another massive bite directly out of their regulatory capital right at the exact moment they need it most.
And this is where Section 382 of the IRS code becomes the elephant in the room. Because even if they find an external savior, say a private equity firm that wants to inject capital, if that rescue results in an ownership change of more than 50%, the IRS strictly limits how much of that DTA the new owners can use.
Right. The government doesn't want companies buying failing banks just to harvest their tax losses.
So this massive asset is essentially locked in a binary state. It's either a powerful engine for future cash flow, or it's another phantom asset waiting to be zeroed out.
Which is exactly why Wall Street demands a timeline. Uncertainty regarding assets like the DTA or the true depth of the cannabis sludge is what causes a stock to bleed out slowly every single trading day.
And that perfectly transitions us to part 4, management's forward guidance. And specifically, the date O'Brien circled on the calendar for the market.
Labor Day.
He set a firm deadline, Labor Day. He stated the goal is to have the entire financial restructuring, the final capital plan, and the complete audit of the toxic assets fully resolved and announced by the end of the third quarter.
Setting a hard deadline in the middle of a turnaround is a high-risk, high-reward strategy.
Why do it then? Why paint yourself into a corner?
By drawing a line at Labor Day, O'Brien is attempting to build a firewall against market panic. He is effectively telling institutional investors, give my consultants the summer. Let us finish turning over every rock in the commercial real estate portfolio.
Right. Just hold on a minute.
Let my investment bankers finalize the capital strategy. Do not panic sell today because I will give you the final definitive price tag for this cleanup by September.
But even while setting that date, he was remarkably, almost alarmingly candid about the emotional reality of the audit process. When an analyst asked if he felt better or worse about the bank's position than when he took over 60 days ago, O'Brien didn't offer a polished PR response.
No, he said, I've had good days and bad days.
Which is wild. He admitted the first couple of weeks were rough, but things have stabilized slightly. I appreciate the honesty. I mean, it beats corporate gaslighting, but it hardly inspires ironclad confidence in the legacy loan book.
While a seasoned turnaround specialist will never prematurely declare victory. If he promises the bleeding has stopped and then they uncover another botched cannabis warehouse in August, his credibility is permanently destroyed.
Yeah, that makes sense.
He has to keep expectations grounded. He openly acknowledged that much of the pain was simply due to poor pricing and poor structure, which is an admission that the previous regime jumped into deep waters without consulting specialists.
But the overriding anxiety hanging over this stock isn't just about the bad loans, it's about how they fix the holding company liquidity trap.
Right, the double leverage.
When pushed on the capital raise strategy, O'Brien played his cards close to his chest, stating he hadn't made formal recommendations to the board yet. However, he dropped one massive, incredibly specific hint.
He did.
He casually mentioned that during a turnaround at a prior bank, he successfully executed a, quote, debt for equity swap.
That phrase is the nuclear option.
Yeah, I got chills reading that.
If you are a retail investor holding common stock in BCBP, debt for equity swap are the four most terrifying words you can hear on an earnings call.
Let's break the mechanics of this down. If I'm holding common shares, why is a debt for equity swap my nightmare scenario?
Let's return to the double leverage analogy. The holding company parent owes $40 million in subordinated debt.
Right.
The subsidiary bank can't send up cash, so the parent is facing imminent default. In a debt for equity swap, O'Brien goes to the institutional lenders holding that $40 million in paper and says, "We are out of cash.
We can't pay you."
Right. If you force us into bankruptcy, you will spend years in Delaware Chancery Court fighting for pennies on the dollar. So let's make a deal. Cancel the $40 million in debt, tear up the notes.
Okay. And what do they get in return?
In exchange, I will print millions of brand new shares of our common stock and give them to you. You are no longer lenders. You are now the majority owners of the bank.
Wow. So the holding company survives, the debt is vaporized, the subsidiary bank goes back to business as usual, but the existing shareholders?
The existing shareholders are mathematically decimated.
Because of dilution.
The dilution is catastrophic. The bank has to issue so many new shares to satisfy the debt holders that the legacy common equity is essentially wiped out. If you owned 1% of the bank before the swap, you might own 0.01% after the swap.
So the intrinsic value of your shares just collapses.
The corporate entity lives, but the legacy retail investors pay the ultimate price to fund the rescue.
And this threat is exactly why the regulatory environment is so critical right now. An analyst smartly asked if the bank was operating under a formal regulatory consent order.
Yes.
O'Brien navigated the question perfectly, stating, "If there's an order, we would disclose it," which is legally accurate. He claimed to operate on a no-surprise basis with regulators.
But we have to read the subtext there. Even without a formal, publicly disclosed consent order, banking regulators possess immense informal power.
They are definitely in the room.
They are absolutely embedded in BCBP right now. They can use informal memorandums of understanding MOUs to restrict dividends, dictate capital ratios, and aggressively pressure the board to accept a highly dilutive capital raise or a debt for equity swap just to protect the FDIC insurance fund.
Right. The regulators do not care about the retail shareholders' equity.
Yeah.
They care about systemic stability. Which brings us to part 5, our talk ticker's bottom line. We have synthesized the data, unraveled the double leverage, mapped the timeline. Now, we have to take an opinionated stance. Let's build the bull case first. If I'm a contrarian value investor looking at the wreckage of this stock chart, what is the argument for buying?
The mathematical bull case relies entirely on quarantining the sludge.
Okay.
If you can look past the 2020-2023 vintage loans, the core franchise is surprisingly resilient. They have a $100 million annualized operating revenue engine. Their net interest margin is over 3%.
They are actively shedding bad liabilities.
Right. They have proactively shed expensive liabilities to protect their funding costs. They have modernized their corporate governance, making them an attractive target for acquisition or a private equity injection.
And if they survive without massive dilution, they have that $25 million deferred tax asset waiting to supercharge their future cash flows by shielding them from the IRS.
Exactly. The bull case requires you to believe two things implicitly. First, that the $16.7 million C&I provision taken this quarter represents the absolute worst of the damage.
That the bleeding is stopped.
Right. And second, that O'Brien can orchestrate a capital solution that avoids a catastrophic debt for equity swap. If he threads that needle, the bank emerges leaner, highly profitable, and heavily discounted at today's prices.
But the bear case is practically screaming from the transcripts.
The bear case is undeniable. The CDO himself categorized the absolute volume of criticized and classified loans as shockingly high.
You don't say that if everything is fine.
No, you don't. Management openly admits they are only halfway through their audit of the C&I portfolio, and they haven't even fully stress tested the broader commercial real estate book yet.
That means the probability of uncovering more 100% charge-offs, more botched cannabis warehouses, or Phantom Business Express collateral is dangerously high.
The sludge is still in the pipes, and the holding company structure amplifies every single failure at the bank level.
Right, the double leverage.
Yes. The bear case assumes that the double leverage liquidity trap is insurmountable without external dilution. even if the underlying community bank survives and continues to serve its local customers, the holding company will be forced to execute that debt for equity swap, effectively zeroing out the current retail shareholders.
So, synthesizing this into actionable advice for the listener, this is no longer a bank stock. This is a highly speculative, binary distressed asset play.
It absolutely is.
If you currently hold BCBP because you bought it for the dividend 3 years ago, you have to accept that the dividend is gone and you are locked into a violently bumpy ride through the third quarter.
And if you are an opportunistic investor considering buying this stock as a turnaround play, patience is your greatest advantage here.
Just wait.
You must wait for the Labor Day restructuring announcement. You have to see the final audited price tag of the loan book cleanup. More importantly, you must see the exact mechanical terms of how they resolve the holding company debt.
Because the current share price might look like a massive discount to historical book value, but that book value is a mirage until the capital structure is finalized.
That is a definitive takeaway. The diagnostic X-ray is incredibly murky today. Labor Day is when the final MRI results will be read to the market, and until then, you are gambling on the severity of the disease.
Yeah, well said.
Understanding the plumbing of the financial system, how double leverage traps liquidity, why specialty property appraisals fail, and how deferred tax assets can evaporate is the only way to separate a speculative gamble from an informed investment thesis.
And before we close the book on BCB Bancorp today, I wanted to leave you with a broader systemic question to ponder. We just spent this entire deep dive dissecting how this specific bank got burned by jumping into specialized assets like cannabis warehouses and frictionless fintech loans during the zero interest rate boom of 2020 to 2022. They chased yield because they felt they had no other choice. But BCB Bancorp was not operating in a vacuum. Every single community and regional bank in the country faced that exact same zero interest rate environment.
Every single one of them.
Every executive team faced that exact same intense pressure to deploy deposits and chase yield. So if a new CEO can walk into BCBP and instantly uncover $30 million in complete zeros, how many other local banks are currently sitting on identical, ununderwritten landmines in their commercial real estate portfolios?
That's the billion-dollar question.
How many other bank boards are praying they don't have to hire outside consultants to look at their books? The diagnosis for BCB Bancorp is murky today, but you have to wonder just how many other banks right down your street have an X-ray machine that is fundamentally broken. Keep digging, keep questioning the numbers, and we will see you on the next deep dive.